Hello, I'm Anthony Saccaro, founder and president of Providence Financial and Insurance Services, located right in Woodland Hills, California, and also a host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. And this is a weekly update that I'm doing on January 22nd, 2016, really with regards to what's going on in the market. So my goal is just to take maybe 5 to 7 minutes, and we'll see how that goes. They tend to be long-winded, and try to make sense of what really is not making sense right now with the stock market. Congratulations to the stock market. We just had the worst opening 3 weeks in stock market history. Looks like it may be the worst opening month in history, depending on what happens. And a lot of my clients and a lot of people that I run into or talk to from our radio show or some of the different media interviews that I do are asking me what's going on and, why is the market acting the way that it's acting. And really, in trying to keep it short, I think there's a couple of different reasons. I think China is a big reason and things that are going on with China. And I think oil at this point is probably even the bigger driver, oil. And a lot of people ask me, well, how does that all fit in? How does oil fit in? I was sitting with a couple of my clients just last week, and, one of them had said, hey, isn't low oil supposed to be good for the economy? I mean, everyone's spending less for gas and so on. So I want to just address those issues as well. So, but overall, what I think is happening is when you look at China, let's talk about China first, is that right now, they're the second largest economy in the world behind the U.S., and they're faltering. Now, when I say faltering, they're missing their growth expectation, which was a little over 7%, and they just said that for 2016, their growth is probably going to be 6.9%. Now they're making a big deal of that, and so is the rest of the world. But the reality is that that's absolutely phenomenal growth. The United States would die to have 6.9% growth. Right now we're trying to get to 2% growth. So it's actually very interesting that they're trying to grow so much. But historically, that's what they've done. From 2006 to 2008, China grew almost 400%. Their stock market just went straight through the roof. So the fact is that from 2008, the market crashed, and it crashed by more than 50%, and now it's come back, and now it's down a little bit. But the bottom line is they could drop another 40 to 50% and be back to where they were in the 2008 level. So there is a long ways that they could possibly go still because they grew so fast, so quick. Even though the market's down 40%, there's still going to be a long ways to go. So that's one issue, and that's weighing on the United States. Then, of course, they're manipulating their currency, which makes the United States exports more expensive. When they devalue their currency, it strengthens the U.S. dollar, and that means that anything we export to them is going to be more expensive, and then that's the bigger issue. Again, you might say, well, if they weaken their currency, then it becomes less expensive for us to import, and that's true, but we're only talking about less expensive by like 2%. They've made a big deal about the 2% Chinese currency being devalued, but when you look at currencies like the euro, well, the euro is down something like 10%. Actually, it's even a little more than that. So really, it just doesn't make a lot of sense as far as China is concerned and why they're making such a big deal about a 2% drop, which, of course, is something that happened towards the end of last year. But China is weighing on the United States economy. That's part of the issue. Oil is a bigger part of the issue as well. You might think that, because oil price is down, that it's cheaper at the gas pump and people have more money to spend, and you take that money and spend it in the economy, and it helps the economy grow. Well, there's a couple of dynamics to think about. First of all, I feel like people are smarter this time than they were in 2008. 2008 was the calamity and the crash of 2008 was caused by the fact that interest rates were so low that people refinanced their homes, took all that money, and went out and bought stuff, and it really drove the economy up. And I actually shouldn't say 2008. I should say 2008 is when it ended. Really, this went on from 2002 or 2003 until about 2007 or 2008. People were using their homes as a piggy bank. They could get loans. They could refinance for cheap. They could pull money out. They didn't have to prove their income. They were called stated loans or liar's loans in the industry. And there wasn't a lot to have to qualify. They could pay a whole lot less than they were paying for rent and actually own a home. Or if they owned a home, they could pull cash out and use it for whatever they wanted. So people were spending the money, and that's what caused the market to do well between 2002 and 2008 before it actually ended. And yet this time, I think it's a little bit different. This time, people aren't doing that. People are taking their savings from the gas pump and they're paying off some of the debt that they've accumulated during 2008 to now. As unemployment was up and people weren't working, they went into debt. People are actually being smart. They're using that money. American debt is going down for the first time in many, many years. That's absolutely a wonderful thing. So they're not taking that savings and putting it into the economy, which means it's not helping the economy. But the second dynamic, and to some degree, maybe even a bigger dynamic, is what's going on behind the scenes with oil. It costs somewhere around $50 to $60 a barrel for the United States to get oil from the ground into your pump. So the United States have some reserves, but it costs them $50 or $60 to get those reserves to where they are. So if they're selling those reserves at $25 or $30 a barrel, they're losing money. And you can't operate losing money. These big oil companies can't operate losing money for too long. Now, most of these big oil companies, well, some of these big oil companies, the Chevrons, the British Petroleum, the Valeros, the Exxon Mobils, well, they're ready for this. They've got massive cash reserves. They've got massive oil reserves. They know that oil fluctuates, and they make money from a lot of different things. They make money not just from oil, but from bringing oil up, from also selling oil. They process the oil. So there's really a lot of different ways that they make money. So really, I don't think we have any issues to worry about as far as those big companies are concerned. But there's a lot of smaller companies, the oil drillers per se, that's how they make their money, and they can't operate at $25 or $30 a barrel. There was one company, I don't remember the name of it off the top of my head, but there was one company that late last year laid off 50,000 people, and that's a lot. That's a lot. And there's about a dozen companies right now that are really on the edge and slated for bankruptcy. As long as oil stays down this low. So all of a sudden, you're going to have a lot of unemployed workers out there. Unemployment will probably go back up, and the oil industry affects everything. So that's behind the scenes. And so China and oil, two big issues that are right now kind of coming in ahead, and it's affected the world economy, and it's affecting the U.S. stock market, the U.S. economy as well, too. So how do we put that all together? Is there going to be another big crash? Is the market going to keep going down from here? I mean, we're down about 12.5% year to date. So in 3 weeks, the market's gone down 12.5%, kind of like it did in August. And where do we go from here? And that's the question that everyone wants to know. Well, the fact is, in the short run, no one knows. In the short run, we can't answer that question. I don't know what the market's going to do today, tomorrow, next week. Over the long run, I think we're going to have a steady decline. We have 200 years of stock market history, and the fact is there are predictable and repeatable trends that have occurred in that 200 years, and I don't want to take time in this video to talk about what those trends are, but when you look at those trends, very clearly shows that we have some problems ahead. And at the beginning of 2015, just a year ago, January, as a matter of fact, I was invited back to New York to speak on CNBC, and they wanted my notes ahead of time, and I told them that in the long run, I think we're going to have another major crash, and it could be worse, and probably will be worse than 2008. And the market in 2008 crashed 55 to 60%, depending on which indicator you look at. And I think it could be worse than that. Well, immediately they got back to me and said, no, you can't say that. You can't say that. So you do want to be careful with what you listen to out there as well, too. But so I'm sharing with you what CNBC wouldn't let me tell the world, and that is I think it could be worse in 2008. And I'm not going to get into the dynamics of why, but if we spent an hour together, I think you would understand. And for those of you that are my clients, and we've spent a lot of time together talking about this. But is that going to start now, or is that going to start sometime in the future? I don't know. I feel like the economy is acting kind of like a rubber band. Right now, it's been stretched. It's down 12.5%. People are fearful. People are worried, and the rubber band is stretched. And yet, we could come back up like we did in August. In August, the rubber band got stretched, but then in just a month and a half or two, we got back. And so the tension was released. If you go back throughout the last year, that rubber band has been stretched, and then the tension was released. It's been stretched, and then the tension was released. And, if you go back just 5, 6 years, it used to be that a 100-point movement in the Dow Jones was a big movement, made headlines. That's not a big deal today. The market was up over 130 points when I started this video. 100 points is not a big deal today. Then it got to 300 points, where if it was 300 points, then it made headline news. Well, now that's not as big of a deal today as it used to be. Now, all of a sudden, the market's moving 500 and 600 points at a time. There were several days in August where the market moved over 500 and a couple days over 600 points. We had a couple of days last week where the market went down over 500, 600 points. As a matter of fact, 2 days ago, the market was down, I believe, 460 points, and then it ended down only 150 or 160 without me actually going back and looking. But massive moves in the market. What's happening is that rubber band is stretching and being released and stretching and being released and stretching and being released. And what's going to happen if you keep stretching and releasing that rubber band? What's going to happen at some point when the rubber band is stretched again? It's going to snap. It's going to snap. And that's what's going to happen to the U.S. economy. I don't know whether this is the start. We could go from the Dow at 16,000. We could go back to 18,000 before it stretches again. I don't know. But over the long run, I believe that we've got some problems. And the reality is that the market is very elusive. It doesn't fall like a rock in the ocean. It doesn't just go straight down. It falls more like a feather that's dropped out of an airplane. It comes down a little bit and then maybe catches an updraft and goes back up. But ultimately the descent is down. And when you look at 200 years of history, the market doesn't crash in a day or a month. Yeah, it might go down 1,000 or 2,000 points in a month or even a day. But over time, if the market's going to lose 50 or 60% of its value, as I think is possible, maybe even likely, then the reality is that it's going to do it over a period of a couple of years. It's going to do it over a period of a couple of years, not just in one day. As a matter of fact, to end this video, if the market doesn't go down at least 30% from where we are right now, at least 30%, then we'd be breaking 3 Guinness Book of World Records that have been in force for 200 years. The first Guinness Book of World Records it would be the first time that the market recovered after only 13 years. The market in 2000, the Dow Jones, was 11,700. And it went up and down and up and down. But at the end of the day, in 2013, the Dow Jones was at 11,700. No growth for 13 years. So it would be the first time that the economy recovered after 13 years. The second Guinness Book of World Records it would be the first time that the market recovered without having a third major crash. In 200 years of history, in all of these longer-term bear market cycles, they usually last 20 years on average. The longest one's been 25 years. That just means there's been lots of ups, lots and downs, but at the end of the day, for 20 to 25 years, there's been no growth. And in every single one of these 20 to 25-year periods, the market's gone up and down and up and down and up and down. And there have always been at least 3 major crashes in this 20 to 25-year period. And so far, in this current cycle that we're 15 years through, we've only had 2 major crashes. We had a roughly 50% drop in 2001 and a almost 55 to 60% drop in 2008. Only 2. We're waiting for that third major crash. And if it doesn't happen, then we'd be breaking a Guinness Book of World Record that's been in force for 200 years. The third major Guinness Book of World Records has to do with price-to-earnings ratios. Price-to-earnings ratios have to get down to single digits, or I should say in 200 years of history, before the permanent recovery has taken place. I should say they have always gotten down to single digits before that permanent recovery has taken place. And without explaining price-to-earnings ratios and what that means, we're getting a little more technical. It just means how expensive companies and stocks are. The bottom line is we've never gotten down to single digits during this current time. The lowest we got was right around 13. So we need to get to single digits to keep from breaking that Guinness Book of World Records. So Bottom line is there are 3 Guinness Book of World Records that are intact, that if we don't drop, if the market doesn't drop by at least 30% from here, then we'd be breaking those 3 Guinness Book of World Records. And I'm just not willing to gamble and bet that that's not going to happen. Now, it could happen, but if you're talking about your retirement and your money, do you want to bet on the slim possibility that these 3 Guinness Book of World Records actually get broken? Or do you want to bet on the probabilities? And for me and my clients, I'm betting on the probability that we have at least another 30 to possibly as much as 60% crash from here. So that's my weekly update. If you have any questions at all, whether you're a client of mine, or especially if you're a client of mine, our door's open. If you're not a client, I'm going to make the video public. So if you're not a client, you're watching this, you can always contact me. Our website's a great place to get all of our contact information. Our website is providencefinancialinc.com. providencefinancialinc.com. Our phone number here at the office is 818-887-6443. Hope you guys have a great week. God bless.